let's talk about the opposite of that, shall we, Steve? This is a company called SSP, which is a FTSE 250 company. Now, do you know what SSP in this context stands for? That's, by the way, P for, well, you tell me. SSP stands for, Steve?
I've no idea.
Steve and Paul, correct. Yes.
Yes.
This is the company that we founded. No, it's not. It actually stands for Select Service Partner Group, which is an awful name. And SSP isn't really very much better. But it does give me a chance to ask you, and you probably saw this question coming recently, Steve. And I imagine you know the answer. You don't really need to think about it for very long, but I'll give you a moment in case. When was the last time, Steve, that you were in an Upper Crust or a Caffe Ritazza? You may well have an answer to that. I personally have an answer to that, and the answer is bloody never have I knowingly been in one of these things, at least as far as I can tell. I think I may have wandered through a Caffe Ritazza at one point looking for a toilet. But that's not really in the spirit of the question I was asking there. Anyway, back to you, Steve. When was the last time you were in one of these three places?
I think I think, and I'm not sure, but I think there's a Caffe Ritazza at one of it might be Leeds station, and I think I walked straight past it. I have had a Millie's cookie delivered before, but I would suggest that that's probably not one of the brands that they own outside of the sort of captive markets. But there's a lot of brands in here that I recognise and I've seen, but I couldn't tell you the last time I stepped foot in them, Steve.
You sound like David Cameron talking about a West Cornwall pasty company, but you have nonetheless gestured to what this company does. Last week we talked about WH Smith, and when we first kind of covered this on this show, we sort of broke the thing down into two businesses. One was a kind of high street arm, and another was what they call their travel division, which involves running retail operations, which are usually pretty horrible businesses, in slightly more promising kind of locations. So places where people can't buy the thing online or easily go somewhere where it's cheaper. So that's things like airports and train stations and so on and so forth. And SSP is the largest operator of these kind of airport, train station, Caffe Ritazzas and Upper Crusts and so on. There's a reason you don't see them on the high street. They're not that great, and the high street's a really bad place to put them. You put them where everyone else is. But they do exist in places like train stations and so on and so forth. As you gestured, there may well be one in Leeds. Who knows? WH Smith took a hit last week, as we pointed out, from accounting scandals. I have no reason for thinking that SSP is about to get itself into a accounting scandal. But hey, I didn't have one about Smith. So let's have a look at this one instead. They have an interesting way of using their kind of distinctive positioning, which Smith's, as far as I can tell, does not. So airports and train stations and so on are kind of complicated places to go opening retail franchises. Airports especially, they have, obviously the nice benefit is you have limited competition on the supply side. You get to charge people higher prices. Someone who talks about these, I chatted to about some UK stocks, was telling me he was in, I think, Luton Airport today, and saw WH Smith selling a bag of Haribo slightly bigger than your average for about £4, which seems like a strong business. But you have to deal with various challenges, which are things like weird timings and people show up at kind of odd hours, and you need staffing to deal with that. And also security is a thing you have to work around quite a lot in an airport. So it's not really worth it for a lot of places to try and develop the expertise to try and run a franchise in there if you're somewhere like Starbucks, for instance, which mostly has company-owned stores. Opening a franchise in or an outlet, in an airport is hard work for Starbucks. But if you have the kind of expertise that SSP does, which is to say you're well used to operating in these kind of environments and the specialist skills and knowledge that you need for that, opening a Starbucks might not be terribly difficult for you. And they do run a number of franchised Starbucks outlets, because if you're anything like me, you see an Upper Crust and you think train station sandwich. And train station sandwich to me doesn't really sound like something that I'm necessarily drawn towards, perhaps irrationally, to be honest with you. I'm not convinced necessarily that the food to go M&S thing or the WH Smith is any better, but I think train station sandwich, I tend to go in the opposite direction. However, a Starbucks in an airport looks like a much more promising thing to me, and they get preferential terms for running this franchise, because it's not something that Starbucks is going to be able to do by themselves very easily. And so SSP kind of gives them an opportunity to stick an outlet in a place where one, we think it's quite attractive, and two, they wouldn't be able to put it otherwise. Okay, so much for the kind of overview of this and where it's different to WH Smith. Reasonably promising so far. Here's the kind of less good bit. On an IFRS basis, it's mostly unprofitable. Despite selling sandwiches for north of £500, they don't seem to be able to make any money using this thing. Well, one reason for that is our favourite kind of reason. They've had some write-downs of stuff across in Italy, and they've overhauled their IT system recently as well, and that's weighing on their kind of IFRS earnings. The guidance for this, which should be a bunch of one-time costs, who knows. But analysts are expecting sort of 16p a share in earnings by about 2027, which at today's prices gets you to a P, or at least when I wrote this, which is a couple of weeks ago now, gets you to a PE ratio of 11. Might be a bit lower than that now, because I think the stock's still been falling. Balance sheet wise, they have, I was trying to work out how much in net debt, to be honest, but I'm looking at a leverage ratio of 2.2. They're trying to bring that down to below 2 or so. UBS has a sell rating on this stock, which is kind of interesting, mostly based on cyclical lower demand from the US and India, and travel demand being fairly weak. That seems like a short-term issue. Their price target last time I looked was £1.70, and I think the stock might be below that now. So whether or not they think you ought to sell it at these prices is a whole nother question. But it's down 12% this year, so UBS may well have been above that level when they were saying sell. And I wonder, with this kind of thing, Steve, it doesn't immediately jump out at me, but maybe I'm just a bit jaded by looking at Smiths recently. There's clearly some decent expertise here. They've got a niche and they're the biggest operator in it. And I can see why you might like this one, Steve. But what do you think?
I think there's an opportunity to for it to turn around. It's been a very poor performer since it, as far back as Google will go. Google says that they've got it back to July 2014, where it was about £2 a share, and it's at 154 at the moment. So it's down about 6% since you wrote your piece, Steve. So there is an element of adjusting to do that. But yes, looking at this company, they've actually got some decent brands, brands that they own, brands that they franchise on behalf of others. But just to give you an idea of the sort of franchising quality, there's M&S food to go on there, Burger King, Starbucks. The other three I haven't heard of, but I don't think they're in the UK. So there's a Ajisen Ramen, and there's an O'Leary's and a Jamie's Deli. But yes, they've got Pete's Coffee, which you'll have seen, obviously Spa, Leon, that you've probably seen when you're about these places. Always sort of brands that they franchise. The brands that they own are less strong. Upper Crust, Ritazza, as Steve said, Millie's. And then from that point onwards, I'm not really sure. I've definitely seen some of these logos before, but I couldn't tell you where I saw them, and I almost definitely didn't go into them either. So, I think that's, the like-for-like sales are okay in this last report, Steve. In July, like-for-like sales up 5% across the board. Weaker in sort of Central Europe and very weak in North America, but the guidance as well isn't terrible going forward. There's not, with a good CEO in its place here, there is an opportunity for this company to turn around. Now, does it have a moat? Is my sort of main kind of point with it, because if it does have one, it's struggling with it at the moment. We like the captive audience kind of companies. You kind of stuck around. British trains are late a lot often, so you're kind of figuring out what you're going to do with your time when you're in there. Are you going to go for a coffee? Yes, that could happen. I get that, but then as you start spreading across Europe and into Asia and into North America, that becomes less of a problem really for them. So they need a kind of different something there to differentiate them, and I'm not really spotting what that is. I'm not spotting any big American brands either in there, which is kind of taxing to me. I think it looks interesting, and I think it looks interesting because it's just had such a terrible time. I mean, it was doing okay up until COVID hit, and then it dropped down to sort of like the 240 sort of area, maybe just a little bit below that. So yeah, it looks like the share price to me, Steve, has tried to rally a couple of times, but it's just kind of failed every time it's tried to come back from COVID, and it's now like what is that, a quarter lower, maybe a third lower than it was during COVID. So not looking particularly good. Just having a look at the CEO as well. He's been in place since 2022, and I understand immediately why you're interested in this, Steve, because he's an Oxford boy, and he's also got a doctorate. He's a doctor of philosophy as well. So yes, you completely screwed us over here by talking about one of your colleagues who you talk to all the time and stuff, and you're desperately trying to get his share price up. But yes, he's from Green Core Group. He was there 15 years. He's had about 50 million chairman positions, including being at Munster Rugby on the commercial board. And then he's now at SSP Group. He's been there 3 years and 6 months, and I guess he's trying things, but the share price is not reacting in the way that you would hope it would be as the CEO. But all that can change. I think if we can get these one-time costs out of the way and we start putting real earnings down, and earnings are growing and the business is improving, and maybe they make some smart acquisitions, it's going to all turn around in a heartbeat. I guess it's another one of those companies, Steve. It's where you saying it, where it falls for me is, would I bet on that? And I probably wouldn't bet on it, mainly because I don't really understand the sector, nor really the business enough, and I'm not sure on present form there's enough for me to really sort of go on, really to give myself enough sort of bite to think that there is a turnaround here. So, do you want to tell us about your mate Patrick anyway, or Paddy as you know him, and everything else?
Yeah, I did not realise that. Good research. Here is one reason that the stock hasn't particularly rallied since the end of the kind of pandemic. So 5 years ago, it made sense that this would be in a much different position with its share price because all its places were shut. They're not now, and we've had quite a bit of travel demand since then. But one of the issues they've got is that the share count's up 42% over the last 5 years. I mean, not gradually climbing in a stock-based comp way, in a kind of we're in trouble, we better issue some equity to try and shore up our balance sheet sort of way. Their balance sheet also isn't in kind of tremendous shape. Their long-term debt is fairly high compared to where it's been in the past. I'm not saying there's a kind of immediate issue here, but once you start adding that lot on, plus adding the extra share count here, those are the kinds of things that might well make sense of the share price kind of staying where it is, even though the company is probably in a better position than it was 5 years ago. Better be. It is at least doing some business now. So I was trying to work out why I kind of don't like this, and I do like WH Smith for largely reasons that have to do with this sort of thing. I think I'm not super sure. I don't like Upper Crust as a brand, but I don't particularly go hunting down a WH Smith if I want something, especially not a sandwich. I don't want both of them in my portfolio, I've decided, because I like trying to pick winners. For the time being, I'm stuck with Smiths, and the big decline on it means it's risky, actually, because they've got an accounting scandal going on. I'll keep looking at this one, I guess, but it feels like it is a constant struggle at the moment with this particular operation. More reading to be done, more looking to be done, but there is enough there to make me kind of interested, I think. You've been watching a segment from the Playing FTSE show, brought to you in association with our favourite broker, Trading 212. For the full version of the show, check us out on Spotify, Apple, or wherever you get your podcasts. And if you open a new account with Trading 212 using the link in the description, there's a free fractional share in it for you. Just make sure that you use the code FTSE when you sign up. Terms and conditions apply, and do remember that when investing, your capital is at risk.